thank you for tuning in for today's session. I've invited an industry colleague to have a chat to us about changes in the retail insurance space. I know today we've been talking about group insurance. However, there's been a lot of changes happening in the retail space, which I think is worth talking about for those of you who have retail insurance. Today, we'll be talking about individual disability income insurance, which we will fondly refer to in this video as Idii. These are a set of measures that have been introduced by the regulator to ensure that income protection products remain sustainable within the industry. So let's dive right in and let me share the conversation I had with John. Hi, John. How are you? It's been a while. How long has it been? 20 years?
Good memories. And I think you might be right. It may stretch back, just shows my age, you know, some 20 years or so. Absolutely.
Yeah, and at the time you were actually dabbling with group as well, isn't it? And then over the years you've actually progressed to go into the retail side of things. So I know a lot of the topics that I've covered in this channel is all about group, but there's a lot going on in the retail space. I wanted for you to probably touch on your profile. So what have you been doing in those 20 years?
Wow. So that presses a bit of the rewind button, but look, I'd probably say as a flow on from our time looking at both, well, for myself, group and retail insurance claims, moved more in a training and technical space in claims, which after that particular time, that actually progressed with liaising more closely with product, distribution, underwriting space. And I think you get a broader understanding of what's associated with particular changes. In addition to that, working with the actuarial team. So I really enjoyed that. You get a far broader understanding of what's required. And I think over that particular time, it extended to me working more closely with the distribution team and in turn, external advisors, particularly doing road shows, individual advisor visits, and understanding the advisor perspective, I think, again, gives you a much better lens. So probably one of my favorite areas, in fact, is actually presenting to external advisors.
Yeah.
So,
and
more recently
with claims as well, isn't it? So how has that shaped your expertise in product? Because I know attending the previous AIST insurance symposium called out that it really helps to have claims background and understanding, because you're at the coalface to understand what the product is delivering. How has that helped you when you were transitioning into the product space?
Oh, look, no doubt. And I think, given both of us do have that claims background, and I think what we probably have a good eye for is we will see maybe a couple of steps ahead that when you make a particular change in the wording with respect to product and how something would be interpreted, I believe that someone with that technical claims background can actually see, well, do you know what? Is this the intent? It may be the intent, but it may also have unintended consequences that are associated with that. And I think getting that particular claims input inside, any product upgrades or changes is absolutely essential, because again, we can see what impact it may have, and it may not be what was intended by pricing or product at the time. So you need to have that balance. And that also extends to the broader understanding of underwriting, having that particular balanced.
So speaking of which, though, so there's been a lot of changes in the retail space, in particular the changes that were introduced by the regulators around individual disability income insurance. Can you give us a bit of a briefing? What was that all about? Why was that introduced? What was going on? So for the people watching this channel, how do we explain that to them? What brought that about?
Oh, look, it's an excellent lead-in. From a ratings perspective, I want to have the most competitive product on the market and the most sharply priced. And, over some time, something's got to give. What you'll find is income protection, in particular, a whole lot of ancillary benefits or improvements in the policy wording happened over the years. And some might argue death by 1,000 cuts, that over time, we did start to actually see some of the benefits, and you'd sit back and say, do you know what? Maybe that's a little too generous. And is it sustainable going forward? So APRA's intervention, I believe, has actually come in because of the inability of income protection and I guess insurers, and everyone's played the game, actually rein in the actual benefits and additional features. And in turn, that has resulted in an increase in obviously premiums, because what we've found, and historically what we've found is maybe 10 or 15 years ago, your average income protection claim duration used to only run, off the top of my head, for around 7 or 8 months, right? That's now blown out to well over 15 months. And therefore, I'm not up to date maybe with the latest figures in the last 12 months, but it's at least doubled. And there's multiple challenges in that space. We're all acutely aware of mental health claims running for extended periods. Some of those are at a very high sums insured. The extension to that, of course, is most of the audience here should be familiar with agreed value versus indemnity insurance. APRA, one area that APRA's really come in and said, well, look, you cannot offer agreed value anymore. It's not sustainable going forward. So again, that's been reined in.
Let's unpack that a little bit. The agreed value, that's all about having a fixed amount that you're agreeing to insure at the time that you purchase the policy, isn't it? Which means when you put in a claim, you might not even be earning that particular amount of money, and yet because you've purchased an agreed value policy, you're technically getting a sum insured payout based on the value of your income at the time you bought the policy, as opposed to the time at your income at the time of your claim. Would that be a fair representation of the?
We'll say for the majority of people over the years, their income does go up, but it's not the case for everyone. You know, especially with some self-employed individuals, you will get, significant fluctuations. So essentially, if we go back to what income protection is about, it's not about putting you in a better financial position. When income protection was designed, the idea was it would cover you for 75% of your pre-disability earnings. Now, with agreed value, it still was 75%, as you correctly pointed out at the time of application. But what if that particular individual took out the cover during a peak year or a stellar year? So in turn, it could be that they've been holding the policy for 10 years, and for argument's sake, or maybe using an extreme example, but they never earned that income ever again. So at the time of claim, that particular individual is actually receiving, with indexation, factor that in as well, could potentially be receiving 120% of their income because it's either dropped or it hasn't kept in line with inflation or indexation over that particular time. What does that mean from a duration point of view? I think there's an extension to that, and part of why APRA did intervene is not only is that individual receiving a greater amount than their pre-disability earnings or their earnings at the time, but they're also not as incentivized to actually return to work because they are in a better financial position. So I believe that has certainly played a part in the management of durations. Probably one area that insurance policies today, as well as in the past, income protection that is, probably haven't really addressed, maybe partially with business expenses insurance, but I don't believe completely, is if you really think about it in the retail space, when it comes to self-employed individuals, if they are off work for an extended period, whether we're paying them or not, the business may not be sustainable going forward. And if the business actually is closed, the possibility of getting them back to work is obviously more challenging because there's no job to return to. That also extends to an employee whose job may no longer be left open if the employer isn't patient enough or isn't capable enough to actually keep their job open for them. So that's a broader discussion as well that may have, in fact, impacted durations in the income protection space and may very well still do.
Yeah. So you've touched on a little bit there about, their employment arrangement. So what happens if they're actually not working at the time of their claim. Like they may have purchased a policy 10 years ago, for example, with the intent to replace an income loss. But sometimes when people lose their jobs, they don't even remember to cancel their insurance. Are they continued to be covered for income protection if at the time of claim, maybe they weren't earning an income, or, you know, they were kind of let go because of current situation? You know, a lot of people have actually lost their jobs. Are they still covered?
It's an excellent question. So I'll probably answer that in a variety of ways. So for the policies that are outside of the super environment, the short answer is essentially yes, they are. So what that means is, especially, and think about that in an agreed value setting. In an agreed value setting where a client actually has an income protection policy outside of the super environment, they have what we just said, an agreed value policy. Therefore, if they can continue to pay for the actual cover, they are essentially covered for an amount of income, which at the point in time of claim, they're actually not earning. So yes, of course, that again, in turn, is going to have an impact on being able to manage the claim, given that they don't have a job to return to. I will qualify that, though, by saying that there are some policies out there with certain restrictions. So if the person is unemployed for greater than 12 months, some of those policies terminate, not all, but some. Another thing as well is if they are in fact indemnity and that particular individual hasn't worked in the last 12 months and it's a 12-month indemnity, there's not a great deal to actually cover them for. Another thing as well, and it shouldn't surprise too many people that are listening in, I would probably put it to you that someone who's unemployed for an extended period of, say, greater than 6 months may in fact not be capable of actually being able to continue paying for the premium and then in turn cancel their policy. But getting back to your original question, if they do have it outside of the super environment and in fact it's agreed value, they're in fact covered. Inside super, it's a bit more complicated.
Can we touch a little bit on indemnity? For the people who don't know that, what is an indemnity insurance? So probably in the context of what's the difference between agreed value and indemnity insurance?
Indeed. So indemnity cover, and it has, just like a lot of benefits in income protection, evolved over the years. So originally speaking, indemnity cover essentially is, at the time of claim, we would look at the individual's income in the last 12 months. Those familiar with group insurance would say, okay, well, that's essentially what most of these particular group insurance plans are. In the retail space, agreed value just became so popular that indemnity became maybe an afterthought. But obviously, everything with APRA's intervention has changed all that. So, so to cut to the chase, with the lodgement of an income protection claim, one would also, apart from the medical evidence, need to furnish financial evidence from an indemnity point of view to show that their income over the last 12 months supported the benefit that they were in fact covered for. Over some time, again, due to competitor rating house pressures, even indemnity definitions started to get loosened up, so much so that some of the more recent indemnity definitions before the APRA intervention in fact had one's best income in a choice of, so over a 12-month period over the last 3 years. And for someone like yourself and myself, if you go back to when we first maybe had our discussions back in the day, we would actually note that agreed value policies back then were actually just like that, best 12 months in the last 3 years. Well, that's what indemnity evolved to. Again, APRA felt or feels that that's not sustainable going forward. So they've obviously reined in indemnity on all these products going forward to 12 months, but there are certain allowances that they've made with respect to their recommendations. So it could be if someone was on maternity leave or sabbatical, we may broaden the actual income definition to 24 months or an average over 24 months, or if they haven't worked for that entire period. So maybe we can delve into that a little bit further if you like, but But generally speaking, indemnity is now your only choice going forward.
That's right. So while agreed value is a little bit more generous, that's no longer offered in the market, isn't it? Because insurers have been mandated to stop offering that after 1 April 2020. So that's been removed last year. So, however, people who had that policy, they were allowed to keep it, weren't they?
There's hundreds of thousands of these policies out there,
Yeah.
but of course, they have agreed value. They also have all these other ancillary benefits that we are no longer allowed to sell, based on the APRA intervention. And keep in mind, these are still early days of the APRA approved products. So the reality is, over the next 12 or even 24 months, it could very well be that the majority of income protection claims in the retail space will remain with these particular ancillary benefits, including agreed value. So certainly still very topical. And the only other thing I would add on agreed value is the focus is on the front end with respect to total disability and, agreed value and how it works. There's probably one benefit that sticks out in my mind that's often overlooked in the partial disability space there, Princess. And I think it's been around for a very long time. And for those, and I'll probably try and simplify it as best as I can, but for the purposes of a partial disability claim, one or an insurer needs to compare one's pre-disability earnings to that of their earnings while they are partially disabled. And there's a formula that's actually used. When we talk about pre-disability earnings, by its very definition, one would probably gravitate to thinking, well, pre-disability earnings means my income just before I became disabled. But again, quite some time ago, insurers actually changed their definition of pre-disability earnings. And in turn, what that actually meant was one had the option of providing, if my policy was 10 years old, I had the choice of selecting my best 12 months, not only all the way back to when my policy was taken out, but up to 2 years prior to that. So in effect, you've got 12 years, if your policy has been enforced for 10 years, 12 years to select your very best 12 months for the purposes of calculating a formula regarding partial disability. So when one thinks about that, it could very well be that they had an absolutely stellar year 5 or 6 years ago for maybe a variety of different reasons, and it's not really reflective of their earnings.
Is that when they've got like lumpy income?
That's right. So what you may have is you may very well then have a partial disability claim that's based on a formula of a highly inflated income based on some income 6 or 7 years ago, and that blows out the calculation. And again, in turn, it means that even if the person's earning a reasonable income while partially disabled, they're unlikely to ever touch that pre-disability earnings. So yes, it still needs to be tied medically, but it is challenging.
Yeah. So just clarifying partial disability income, can we just unpack that a little bit? That's about someone who's not completely disabled, like they can still do a little bit of work and they've just lost part of their income. Is that what partial disability income is?
Well, that's right. So in effect, with partial disability, and again, depending on the circumstances around the type of policy they've purchased, some policies, some of the more premium policies prior to the APRA intervention allowed for what's known as day one partial. But for the majority of people, what you'd find is if someone had, say, a 1 month waiting period, they were off work for 2 or 3 months, maybe they had for argument's sake, a knee replacement, and that particular individual was off work for a particular set amount of months, but then they slowly returned to the workplace, maybe at 50% capacity, 50% of their hours. And in turn, one would imagine that would mean that they're not earning their full income. And that's what partial disability is essentially about. And again, and it certainly has a place. It's vitally important. And I'm sure even with the APRA intervention, it hasn't touched, in effect, the definition as such. What it has done, however, is it's just reined in that whole agreed value and the financial circumstances associated with that.
So that's the change that was introduced end of Q1 last year. But there were further changes which in fact nearly changed and reset the landscape for retail insurance, and they all just went live on the 1st of October this year, isn't it? Because it's almost like everybody's been put on a level playing field. You all get to reintroduce a brand new product, and all of the insurers launched their brand new Idii product from 1 October. So, everybody's keeping their cards close. Nobody knew what that new product was going to look like. Just walk us through what that 1 October was all about.
Oh, gee, yeah. So 1 October, it's huge. We're bouncing so many different ideas around. And I think some of the key considerations, and as you correctly pointed out, last year we could no longer sell agreed value. So that was the first step. But there's a whole lot of further key recommendations. And one of the other recommendations from APRA was that durations at full age 65 benefits had to be reined in. So what that essentially means is, I think like I touched on earlier in this discussion, durations have blown out. And essentially APRA has reservations around someone being able to have cover all the way to age 65 with generous definitions of total disability. So I may just touch on total disability and how it broadly looked prior to the APRA intervention and how it actually looks today with the APRA intervention. So total disability, again, just like other definitions, slowly started to become more and more generous in the way it was defined. But the core definition was more around an individual's inability to perform one important duty of their occupation. So that has remained constant, over the years. But over time, again, it was chipped away at where insurers looked at, well, okay, you're unable to perform at least one important duty. And the reality is the majority of individuals who were claiming for total disability were in fact unable to perform more than one important duty. They weren't capable. And again, I should emphasize again, the overwhelming majority of claims are in fact genuine, and those that are totally disabled because they cannot perform their duties. But what happened over time is it evolved. And what actually evolved was, apart from one's inability to perform one important duty, it extended to, we'll allow you to work up to 10 hours if you're still suffering a significant income loss of, say, 80% or greater, we'll pay you the full benefit. Okay. But then again, that wasn't enough. We had to make it even more generous. So we split it into a third tier, which was, again, hours-based and income-based. So people on the most premium of offerings in the market, and pretty much most, if not all insurers had that premium offering, were actually able to be deemed totally disabled if they were either one, unable to perform one of the important duties and not working, or this is the important thing, they were working up to 10 hours, but they weren't capable of working anymore. Quite subjective, as I'm sure you can imagine. Or the third one was, irrespective of hours, they were suffering an 80% or greater income loss due to their disability. Again, that one, the income loss due to one's disability probably isn't the one that's as challenging as the 10 hours. I think that, again, APRA didn't like that, and certainly as part of their recommendations, one's not allowed to actually sell such a policy anymore. Comes back to them being totally disabled. And again, most of the insurers now have looked at maybe talking about, rather than one important duty, maybe all their duties or the core duties. So that's evolved. That leads me to, again, durations and age 65. And with age 65 benefits, what you find is APRA did not want that definition to continue for the next 24 months, for that matter. So what happened is some insurers looked at certain changes around how the definition continues after 24 months. One may have that definition of total disability that I was talking about for maybe the first 24 months. After that particular time, the expectation is that maybe is reined in a little bit, and one actually moves to a definition of being able to perform any occupation they're reasonably suited to rather than their own particular occupation at the time of the claim. In fact, other insurers, from an indemnity point of view, have said, well, look, we may very well reduce the actual benefit that we're paying from 70% of their pre-disability earnings. That actually reduces to 60. So that's another way to maybe incentivize people to maybe look at, if they in fact do have an ability to actually get back to the workplace. Maybe at 60%, it may actually push them over to maybe attempt some work. My only reservation in that space is obviously a significant amount of people at that 2-year mark, if they're still disabled, it could be quite serious. So my concern is 60% is not enough. So from an advice perspective, I'm sure some of your audience would probably understand this. I think it's imperative that discussions are had during advice periods when one's looking at taking out insurance around maybe topping up TPD and looking at, because if someone's disabled after 2 years, a significant portion of those individuals may very well be totally and permanently disabled. So it brings in the TPD discussion as well.
I was going to say, like, if you are actually disabled and you're getting a benefit to age 65, one would argue that your condition is no longer temporary. Like, really, you should consider the benefits of total and permanent disablement, because
of course,
who would call the condition temporary if you're getting a benefit payment, income protection replacement to age 65? Like,
no doubt.
Yeah.
Which is interesting, because maybe some in your audience that are more used to group and some group schemes where once someone's deemed TPD, the income protection may in fact discontinue. And I know that they're not all like that, but there are some. Certainly with respect to retail insurance, there's no such the income protection wouldn't discontinue, whether they're being paid a critical illness benefit or a TPD benefit. So again, challenging. There is maybe a school of thought as well that, given income protection today, the way it's sold based on the APRA recommendations, cannot maintain that same definition all the way to age 65, then maybe for some advisors or consumers for that matter, it could very well be that maybe just maybe a 2-year benefit suits them and they take out or top out a higher amount of total and permanent disability cover. So that may be the option as well. The other thing that APRA did, it has made some allowances. And one of those particular allowances is in the first 6 months of one's benefit, they are willing, so the replacement ratios move from 75% to 70%, plus obviously being indemnity, but they are open to the first 6 months going all the way up to 100% in that particular first 6 months, which is interesting. So my gut feel, based on what I've seen from most of the insurers when the 1st of October came around, was most appear to be a bit conservative in seeing, getting the feelers out, get their product out on the market, but actually waiting to see what others are doing as well. So yes, there are some that are allowing, I think in some cases, maybe not necessarily 100%, up to 90%. There's something to that. I mean, my personal opinion is there's nothing wrong with maybe the first 6 months having a top up, because quite often, depending on the medical condition, there may be certain medical expenses, additional medical expenses that are associated with dealing with or the treating of the actual condition. A good example may be if they're diagnosed with cancer. And there may be some medical expenses associated with that, or front-end medical expenses for that matter. The challenge I see, however, a broad brush of allowing maybe top up for all types of claims may be that if you do pay a topped up amount for that first 6 months, is the client incentivized? Again, similar to what we were speaking about regarding agreed value, because for those that are familiar with claims management and rehabilitation and return to work plans, those first few months are key in terms of the claims management. My gut feel is that it could be that the top up, insurers may want to consider the top up only where it's obvious that the client is up for additional expenses. So maybe based on the medical condition at hand. So that's maybe another thing to consider. Short waiting periods for accident or other medical conditions, shortening the waiting period, are other benefits that are still allowed.
Yeah.
So again, there's further options for insurers to be innovative around maybe offering shorter waiting periods for an accident or maybe some other critical type of conditions. So again, another option there. So I won't say it's a blanket simple policy where it's just indemnity. There's restrictions after 2 years. There are still certain things that insurers can do, but my gut feel is they're still getting the feelers out. I think early next year, we may see a little bit more innovation around what's offered, but again, in a more sustainable sense.
So you've briefly touched on my next topic there, which was about the income replacement ratio, right? Because as you said, you're not meant to benefit from your insurance policy. So in the group insurance space, the maximum that you can actually insure in your income is 75% of your salary, unless you're including the super contributions,
of course,
which actually doesn't even go to the person, it goes back to their super account. But in here, APRA had, as you called out, prescribed what they would allow in the first 6 months of the claim, and then they want that to taper back down. They're trying to avoid the 100% of salary. I think some insurers are even doing just 90, and then it tapers down to.
That's right.
Can you just briefly touch on that? What's the more common themes that have emerged out of 1 October? Is it like 90% in the first, 90% of your salary being insured in the first 6 months, and then what happens after?
Yeah, no, look, again, it's a good question. And I think there's a variety of different options. So I will say that there's some insurers that they're not offering any additional top up in that first 6 months. They're simply just saying 70%. There's others that are even offering choice around whether you want to select a 60% replacement ratio or 70%. So that gives you some context there. Some insurers may allow that 90% as an example that you mentioned, or potentially the 100% in that first 6 months. Are they doing it built in? I don't believe so. Most, from what I understand, it's an additional option that you can select and pay for. So again, I see more innovation in that space around whether or not they allow it blanket across all types of claims, or maybe depending on the type of claim. But the replacement ratios that you mentioned, there are certain insurers that are a little bit more conservative around the 70% up until a particular sum insured. Because the other thing that APRA had actually mentioned in their paper is they were obviously concerned about extremely high sums insured. For example, some insurers, maybe a little bit more conservative, are only allowing 70% of income to be insured up to the first 150,000. And then after that, it scales down, might drop down to 50 or 40% in some cases. Some might allow the 70% up to the first 250,000 of income. So again, there is choice in that particular space. So it's more sustainable, but there is still room for innovation, as you can see there with respect to the replacement ratio. But I think that's got a bit to play out over the next 12 months.
Yeah. Just as we approach the end of our session, it's been so interesting. I think there was a part of the APRA intervention that didn't get through because there was just so much work. And I think there were still discussions happening in the last part of their thematic review. Are you able to just cover off on that one?
Yes, I knew that question was coming. So, look, I believe it was quite a relief for everyone in the industry when that was put on hold. And for the benefit of the audience, I will explain what we're actually referring to there. And that is around the guaranteed renewability of policies. So for those that are familiar with retail insurance, one of the things about it is there's that guarantee of renewability after the policy is actually being, underwritten. So APRA's turned around and actually said, well, you know what? You cannot guarantee it anymore. You need to re-underwrite it, not medically, but financially and occupationally. It was a lot of work and a lot of headaches, I should actually mention, around how we would best administer something such as that. The benefits of underwriting every 3 or 5 years, a policy financially and occupationally, the cost of administering it and the benefits that you would get would be limited. They were the ultimate concern. So in turn, APRA said, well, you know what? Let's park that for 12 months. I don't know if it's going away. My personal opinion, and it is controversial because it may come back to bite me, but my personal opinion is the benefits aren't there. And I personally don't believe it's a necessary move. The key move that they've made around agreed value, tick, we get it. Most people, although even from a sales perspective, yes, you can understand why you would sell agreed value. It makes perfect sense, right? But we also get that it impacted the sustainability. We also get around, maybe the need for durations, the definitions changing. The benefit of re-underwriting financially and occupationally, I personally don't see it. I believe that there are better ways to go about it. And I believe the best way is insurers look at their renewals, so the policy schedules that go out every single year, and reminding clients and being on the front foot with clients around saying, is this income that you're insured for, is it really reflective of your actual income? Do you still support that?
Yeah.
It's also an opportunity. If their income's gone up, they of course have the option of applying for an increase. That's never changed.
Yeah.
So I believe that can be best left to the insurers who have a lot of expertise in that particular space about maybe looking at their letters, renewal letters, the policy schedule, and maybe reminding clients that they will not receive that benefit if they cannot support it.
Yeah.
Leave it to the insurers. I believe that's what they're best at. Due to the costs associated with administering it, I don't see the benefits there. That's my opinion. It may be controversial, but I just don't see it. And I'm not convinced it'll get up. So we'll just have to watch this space.
So I have a final question, and I don't know whether you can answer this. These 1 October Idii products, are they cheaper than the older products that some of the people that have bought policies already prior to 1 October, are the new versions of them meant to be cheaper because they're more restrictive?
That's right. So the view is that they're more sustainable going forward. So in turn, they should be cheaper, which also raises the actual question as well around, well, the current policies that are agreed value, that have all the bells and whistles, that still exist in the hundreds of thousands of them. I think it's not rocket science to work out that over time, those policies, given that they're becoming less and less sustainable, may very well increase in price going forward. So this is the important point that I would like to make. The core reason for income protection is to cover one while they're away from work due to total or partial disability. It is still there, right? Maybe the replacement ratios are a little bit lower. Yes, you don't get the agreed value, but the core intent is still there. There is some room for innovation, like we mentioned, that first 6 months or shorter waiting periods. And, tinkering with replacement ratios up until certain amounts. But if we can keep it sustainable, not get carried away again, hopefully in time, becomes more affordable. So more Australians can actually take out their income protection going forward. And I will say one final thing, and that is about those ancillary benefits and bells and whistles that exist in income protection or existed in income protection. Do you know what? A lot of those benefits are still available. A good example, critical illness or trauma insurance. Some of these ancillary benefits paid double benefits if someone was diagnosed with a critical illness. And, people would have to pay extra to have that additional feature. Well, you know what? You can get that by getting maybe, even if it's a nominal amount of critical illness cover. So just some food for thought in that space as well.
Yeah. Okay. So I think for me, my key takeaway from this conversation is, because there was a grandfathering that was also introduced, these changes were only introduced, the agreed value in 1 April last year, and the IDII product is in 1 October this year. Anyone who had their policies already, they're allowed to keep them with all the bells and whistles they had. So if they were, if they were considering changing policies, or probably just be careful not to let them lapse, because they might not be able to get them back anymore, and you'll be converted to a more restricted policy. So would that be a fair comment? Because the other thing as well is it might not be sustainable. It'll just keep going up in cost, isn't it? Because it's much more expensive too.
Look, that's right. Good point. If you truly value the ancillary benefits that you already have, yes, be very careful about cancelling or letting it lapse for the reasons that you actually gave, Princess, because you wouldn't be able to actually take out such a policy again. I will say there are certain ways where you can make little haircuts to your policy, but still keep your ancillary benefits or some of the benefits that are no longer available to new business. And one particular example, and it's a good takeout, is if someone's got agreed value, and I think as we touched on earlier, the likelihood is going forward agreed value will become more and more expensive. Keep in mind within those product suites at the time, the indemnity definition was more generous than the indemnity definition that exists today. So potentially someone who has agreed value in these premium policies and they're feeling the pinch because of repricing around agreed value, may be able to move their policy into a better indemnity option within that product suite. For the APRA intervention. Remember when I mentioned earlier, there was indemnity, more premium indemnity around best 12 months in the last 3 years. You could potentially take that option within your product suite that you'd taken out prior to the intervention by APRA. So again, there are still options for those particular individuals.
So if customers are price sensitive, then it's definitely an option to convert to the new products that have emerged at 1 October.
No doubt. And one other option that actually springs to mind as well is, like I mentioned earlier, critical illness still exists. And it's an option to maybe top up or consider taking out critical illness or trauma insurance going forward.
Great. Thank you.
I always
Everything
talk too much,
you
Princess.
said is just so valuable, but I should probably point out that we're not giving financial advice, isn't it? Neither you or I are authorized financial advisors. We're really just we're more product people, really. So we're giving out tips and options that are available out there, and then they really need to talk to their financial advisors if they want to tailor some of the things that we talked about to their personal circumstances. Any final
as always,
thoughts?
I think just what you just touched on there is great. So I believe we've tried to do in this particular discussion is maybe highlight options, highlight maybe some key features, where things have been reined back, why it's been done. But I believe, again, everyone's individual circumstances, as you correctly pointed out, are different. So what I mentioned about whether or not agreed value, keeping one's agreed value is for them. Well, some people might be really happy about keeping their agreed value and they can afford to do so. Great, fantastic for them. But we've just given options, just like we touched on about, well, maybe do I top up my TPD? Do I limit my income protection to 2 years? Do I consider maybe taking out trauma or critical illness? They're all options.
Yeah, absolutely. Thank you so much for today. I really, really appreciate everything you've talked about. I've learned quite a bit there as well. Hopefully our tuners have also learned a little bit. And again, not financial advice. We're just putting out there the options that are available within your insurer's product. We're not here to promote any of the insurers either, because there's a lot of options out there.
Princess, thank you for having me. It's a great opportunity to kind of speak on your YouTube channel. Hopefully I haven't spoken too much. I probably have, but it certainly is a topic that's of interest to me, and you could probably keep talking for hours about it. So yeah, and happy to field any questions that any of your viewers actually do have.
Thanks, John. So if anyone wants to reach you, I might just add your LinkedIn contact in the comments box below, so that if they want to ask questions or want to reach out to you as well for any supplementary information that we talked about today.
Yeah, no problem. Yeah, looking forward to answering any questions people might have.
Thank you.
Thanks again.
Thank you again for tuning in. I hope you enjoyed that session and got some value out of it. I certainly did. A reminder again that if you do need to make changes to your insurance policy, please contact your financial advisor. These are complex changes, and it does help to navigate the changes with a licensed professional. I have linked John's LinkedIn profile in the comments box below if you need to reach out. Optionally, you can also just post your comments and I'll certainly try and answer them for you. Looking forward to our next video, and I hope you tune in again soon.